Welcome, everyone. I'm supposed to do a short tease, so
Already off to a bad
we'll
start.
be right back after this. Wow, and they told me there were no new graphics. Thank you. That was pretty interesting, wasn't it?
That was good. Yeah.
All right. Well, thank you so much for joining us on the Real Estate Investor Show. Uh, what is it? Hard money for real estate investors.
It's right there. Yeah.
We are Carolina Capital Management, private lenders for real estate professionals in the Southeast. If you are a real estate investor and you would like us to take a look at one of your deals, go to carolinahardmoney.com, click on Apply Now. If you're an accredited investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and definitely don't forget about signing up for Wednesdays with Wendy. As you know, Wendy devotes 30 minutes per person on Wednesday afternoons, not this month because she's on vacation, to talk about anything real estate related. She's usually booked out a couple months in advance, so grab a spot. There's a link to her calendar, and we will leave it over in the comments section, which we have on the left side of the screen or underneath, depending on the platform you're viewing us from. We're very excited today. We have Bryan Maddex of AmeriFirst Mortgage. He is an expert in the conforming and investment mortgage business, and I wanted to bring him in to have some discussions. Jonathan Davis to my side, and like I said, Wendy is still vacationing. Of course, it's not the vacation she was expecting towards the end, as she ruined her transmission carrying around that RV.
It happens.
That's all right. So listen, let's get started with some breaking news. All right, so if you see sweat dripping off of us, yes, it is summer. For whatever reason, it's really stuffy in this room today. Hey, Sue.
Thank you, Susan.
So breaking news. Yesterday, the Fed announced another 75 basis points hike in their rate. That was not unexpected.
The good news is it was already priced in to most lenders.
Yeah.
Right.
And investors liked it because of the language he used after he announced it. They're basically doing a wait and see kind of an attitude, right?
Yeah. They anticipate they're at the top of the interest rate hike.
They said they're going to be data sensitive.
Data sensitive.
They're going to trust the science.
Trust the science. Man, I've heard that somewhere too before. I can't remember where.
The other news, we are technically in a recession officially, unless you've changed the language that we've always had. Today, the GDP was 0.93. What is it? Retraction, subtraction. We were below par.
Yeah.
By 0.93%. Again, that wasn't unexpected either. We all know we're essentially in a recession, right? Now, job market's still good,
Yes.
right?
Yeah. Mm-hmm. And that's leading to the kind of wait and see model. Is the jobs are saying strong right now that they feel like, okay, well, maybe we can pause adding more rate hikes down the way to see, because we do have such a strong job market.
And in a few minutes, we're actually going to let Bryan talk. So he doesn't have to just sit here and smile.
He will. Well, we're waiting. He has the really interesting stuff.
Right.
This is just commentary.
Now, the job market is going to be a little bit tough in the mortgage business, and I'm going to read off some stuff. I typically don't like just reading off a prompter, but I have a lot here to cover. So experts are forecasting a 35 50% drop in mortgage originations this year. 2021, there was $4 trillion in mortgages, and they're expecting it to go down to $2 trillion in 2022. Most of the drop is due to a decrease in refinancing, which makes sense as rates go up. Meanwhile, mortgage refinance applications are down nearly 80% from a year ago, and that's according to the Mortgage Bankers Association. Bryan, isn't that typically what happens when rates start to go up?
Yeah, you get a lot of extra applications because I can't not refinance. The rates are so good. Well, everybody probably refinanced in 2020 and 2021. And we came into this year with rates in the 3s, but by March they were in the 4s and, you know, pressing the 5s. Right now, if you don't have great credit, you might be getting a 7% rate.
Yeah.
So if you've got a 3% mortgage, even if you've got some debt, sometimes it's not worth doing a refinance. But you want to talk to your mortgage person and look at your blended rate. And a lot of people don't look at what the blended rate is. But if you're
explain the blended rate.
Yeah, so we'll use easy math. Let's say you have $60,000 in a mortgage at 3%, and you have $60,000 on credit card debt, which sounds like a lot, but credit card debt just hit an all-time high last month. So people are tapping into their credit much quicker than they have in the past. And if that credit card debt's at 19%, but it's half of your debt, and then your mortgage is at 3%, it's half of your debt. If you blend those rates, you take 3 plus 19 is 22, your blended interest rate's 11%.
Sure.
Right? And so a 7% mortgage sounds horrible compared to a 3% mortgage, but it sounds great compared to 11% blended debt.
And that 11% is now tax deductible.
Possibly.
Mostly.
Possibly. They've changed a lot of those laws in the Trump era.
So you can't deduct
just equity. You cannot deduct on equity.
So
you used to be able to.
You can only deduct the interest from your original purchase. Is that basically what
I
they're
believe?
saying?
Yes. And then you may be able to deduct if there was some business expenses or some home improvement, but talk to your CPA or financial planner.
And we are none of those.
Bill is not a financial planner or CPA.
Don't claim to be.
May be tax deductible.
So the devil's advocate would say,
yeah,
if I take my credit card stuff and put it into my house, then now if I run into the worst case scenario,
right,
and I can't afford my payments, you know, they can foreclose on me. If I don't put my credit card debt in there and my payments stay low,
right,
I can tell the credit card companies to take a hike. They're not going to take my house.
This is true, and depending on the state, you know, some states offer more protection than others for your primary residence. But if your cash flow is so upside down that your credit card debt's getting worse every month, you're leading towards the inevitable.
Right.
Right. And so if I can refinance and save you $800 or $1,000 per month, now, yes, the mortgage is larger and it is putting your home possibly at risk. But man, if you can reset your finances and now work within a budget that you're allowing you to add your savings instead of adding credit card debt every month, it really is. It's not for everybody. It just depends on your situation, but it could be appropriate still to do a refinance. I've got one closing today. She's going from a 3.25 to 7. We're paying off $40,000 in debt.
Wow.
We're opening up $400 to $600 a month in her cash flow. She's also on a 40-year mortgage. She's not making headway. She's got an equity line that she's been paying interest only on for 10 years.
Wow.
Right. So she's not getting better financially. So yes, we're taking her rate up, but we're going to massively change her situation. Now she's got debt being paid down and has extra money for savings.
And I just want to say, everyone's scared of 7% interest rate. I'm gonna beat it like a dead horse. The average rate over the course that we've been tracking this, since we've been tracking it, is over 7%. 7% is not a bad interest rate.
I've always used 6.5% as the average. And so, yes, we're on the high side of average, but these are average rates.
Yeah.
These aren't high. It only seems and feels high because we came from almost free money.
Yeah. It was free money. 2% is free.
We definitely have been living on free money for a while.
And we don't want to go back to 2020. That economy sucked.
Yeah.
Right.
Mm-hmm.
So we don't want to see 2.5% mortgages. That means the economy is so broken. It's nice when you're borrowing or if you're buying, but it really, it's we're paying for that.
So one last thing on that. are you trying to keep loan to values low?
Yes.
So people still have equity so they can get out of their house if they have to.
Yeah, even FHA changed their guidelines in the last 12 months where you can only go up to 80% of the value of your home. It used to be FHA, you could get up to 95% on a cash out refinance, and they've restricted that. So any loan program that I can do, 80% is our max cash out, unless there's like divorce or inheritance or death. There are ways to get above 80% if you're buying out somebody from the house.
Right.
But for the most part, 80% is the max you can go.
Okay.
Now, equity lines of credit could be an option for some people. Their interest-only payments can be bad. It can be nice, but they can go higher. Some of them will go to 100%.
My concern is, and don't get me wrong, I'm not saying we're going into a 2008, but we have it in the back of our head.
Mm-hmm.
And we want to make sure that there's enough space between what you owe and what your house is worth.
Right.
So you can liquidate without having to bring money to the table or walk away from the house. And
Right.
we'd much rather, if somebody is getting into trouble, be able to sell that house and get out from under it than to walk away from it.
Right.
Yeah.
Right. So we still need to keep that. Part of the problem that we had in 2008 was the 100% loan, the 125 loan.
Thank you, Ditech.
Yes. You can buy this house, fully furnish it, and build a pool all in the same loan.
You don't have to have a job, right? You
That's
just
right.
tell us that you make money and we'll believe you. It was wild times. That's not the underwriting case now.
Yeah,
it's
no.
it's so far different from that.
Completely different.
You,
yes.
I think they have to do a blood test to get a loan anymore. Okay, let's get to the good news. Wells Fargo laid off at least 114 employees in its mortgage lending team following a 33% drop in first quarter revenue. JP Morgan announced its most recent round of layoffs in its lending department on Wednesday, affecting more than 1,000 employees. The bank said some employees will be let go while others are moved to new teams. We're going to talk about diversification in your business model.
Mm-hmm.
As an employee, you need to be multi-skilled. So when layoffs do come, if they have openings in other areas that you can move into, it's only going to protect you. So don't be a one-trick pony, so to speak. Layoffs are much worse at the non-bank lenders, where less diversified business makes companies more susceptible to fluctuation in rates. That's what I'm talking about, is having other verticals.
You're
within
just
your
talking about
business.
mortgage originators who use
Yeah.
a warehouse line and just
That's
sell it
all
off.
they do.
Mm-hmm.
They're more likely to serve first-time home buyers who are first to get pushed out when rates go up as well. I'm going to get back to that first-time home buyers thing when we're talking in a moment. The non-bank lenders also rely more heavily on refinance mortgages, which made up 63% of all mortgages last year, and obviously are expected to fall. I'm going to cover this real quick. Some of these non-bank lenders, Better.com, they laid off 3,900 workers. And they started this back in December of last year. If you guys will remember, the CEO, his name is Vishal Garg, I can't pronounce it.
Yeah, Vishal.
He announced the first round of layoffs of 900 people in a Zoom call. You might remember that.
Classy.
He said, if you're on this call, you are part of the unlucky group that is being laid off.
Oops.
Your employment here is terminated effective immediately. Now, in my opinion, this business was going to go under sooner or later anyway, because if you have
Better.com.
somebody,
or-
yes,
Yeah.
because if you have somebody like this leading your business, the culture there is crap,
Right.
and eventually it would eat itself.
Well, and they
Don't
wanted
you
to
agree?
they wanted to disrupt the market and do a business model where the consumer did everything online, didn't have to talk to a loan officer, and they really thought we're going to change the world in the mortgage space.
Right.
They lost money quarter after quarter after quarter. They were trying to buy market share, and you can only lose money for so long, and then rates go up, and your business model is completely destroyed.
So they tried to get into the market as a fintech, not
Right.
as a mortgage company, correct?
Exactly.
Yeah, they
So they're getting-
took the Amazon model, but
Yeah.
rate,
And they're getting-
rate spikes killed that.
And they're getting rounds and rounds of public money.
Mhm.
That's how they were able to do these mortgages in the first place.
Right.
So yeah,
What reminds me of that old saying? What is it? We it costs us $1.25 to make these widgets, and we sell them for $1. And it's like, how do you make money? Volume. It's like,
Doesn't quite add up.
yeah.
Yeah.
So there were another 2,500 laid off from about a half a dozen larger lenders, plus numerous smaller lenders have made cuts as well. Real estate brokerage firms are starting to feel the heat. Redfin, Compass, both made headlines announcing more than 900 job cuts on June 14th. The CEO of Redfin said, "We could be facing years and months of fewer home sales," which is,
I think it's true.
yeah, I'm not arguing.
I mean,
with
the
that.
inventory is just,
But it says they're laying off Redfin 470 employees, about 8% of their workforce, because they don't have enough work for their agents and support staff. Now, I get the support staff being laid off, but agents, aren't they supposed to be independent?
Well, Redfin's another one of those
1099
companies that wanted to
employees.
do things completely different.
Yeah.
Right. And so they would pay agents, like you wouldn't work with an agent through your home buying process. You would work with Redfin. And if you wanted to go see this house, they would have assigned an agent to show you that house.
Okay.
That agent got paid a fee to take you and show you that house.
Okay, so that agent didn't necessarily work for Redfin. They just got a fee from Redfin.
They were more of an employee model instead of the 1099 model.
Okay.
They're more salary based
Okay,
and,
well, that
and
makes sense.
comped based on activity instead of sales. So they just had it's a completely different business model they wanted to disrupt. And the traditional business model is what's worked forever.
Yeah. So if you're a realtor and you're not eating what you kill,
Right.
then you're going to be subject to this.
The market's going to hurt you a little more.
Yeah, absolutely. And then Zillow announced 2,000 employees lay off 25% of the company in late 2001. A lot of that was due to that wonderful home buying program that they had that they weren't making any money in.
Brian, so we talked about, the CEO said that it was years of, slower home sales.
Right.
Do you see that as well? I mean, because we see inventory, we see, what's being put on the market, which everyone's talking about, but also what is even available in new construction. Like, do you see?
Well, that's the thing is what they don't really drill into is there is less inventory. If there's less inventory, you can't have as many sales.
Right.
And then you've got people who don't have to move right now that are in 2.5%, 3% mortgages. And if they want to move, they're going into a 6 or possibly a 7% mortgage. Why? Why do I want to make that move if I don't have to? Right. So maybe I'm going to say, as the price of houses have gone up and as interest rates have gone up, maybe I want to wait and I want to sit this season out. So we're seeing inventory increase right now. The media, they sell by fear.
Yeah.
They're going to say inventory is going up. That proves the market's crashing. Every summer inventory goes up. Every winter inventory goes down. That's a normal cycle for real estate. So we're going to see that.
Yeah.
And we need to get a little bit of normalcy in the market. We can't sustain 20% growth of housing pricing year over year, which we are for the second year in a row, almost at 20%. I think the official number is 19.3% increase.
Yeah, I saw 19 something. Yeah.
It's crazy.
It's crazy.
The average has been 3 to 3.5% since the 50s.
And mortgage production is down almost 50%. I've seen a lot of numbers that say 35 to 40%. This will still be about the third best year in the last 15 years for mortgage production. It's just the mortgage production set records.
It had been so high, right?
Right. And so I saw another headline that said, I don't remember who posted it. They said foreclosures are up 440%.
Because they were down 1,000%.
We had like 16,000 foreclosures in all of 21, which was ridiculous low. And now it's up to 100,000. So yeah, it's up a lot.
And why was foreclosures down? Not necessarily because people could afford their homes, but they could sell them before they got into foreclosure.
They got
equity.
equity.
They were worth a lot.
Yeah.
Right.
They weren't walking away from them.
And we haven't been doing lending, to your point, from 2008. We've not been doing 100% financing. Right. People have been committed into the home.
Sure.
And then equity has just exploded.
Right.
So yeah, if you're in a bad way, sell. You don't have to foreclose right now. You can sell them and take out some equity.
So I want to get back to the opportunity that I see. And I want to see if you have any comment on this. So first-time home buyers are being pushed out because payments are a little bit high. They have student debt, blah, 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 even though they have a moratorium on the payments. They still have to qualify with the debt. And then everything else is going up in price. So it's harder for them to afford a down payment and mortgage payments. I get that. Now, we've had empty nesters that have been sitting on the sidelines because they're, number one, they're worried if they sell their house, they have no place to go because
Right.
there's a lack of inventory, smaller homes. Now, if we have these smaller starter homes that are going to be more available, I see empty nesters not worried about the higher mortgage rates because they can sell their home, take plenty of that equity, put it down on the house and get a reverse mortgage,
Yeah.
and then never have to worry about a mortgage payment the rest of their life.
Right. So the reverse mortgage is a great tool. It got a lot of bad rep in the 80s, right?
Mhm.
Because there was a lot of people doing some shady things and pushing it to maybe people who didn't need to have that. Well, now it's so hard to get a reverse mortgage. You've got to go through some training and some counseling
Sure.
even to get it. But then they have math that they're going to work out based on your age. You've got to be at least, I think it's 62 and a half or maybe even 65 to get a reverse mortgage. But if you've got assets, right, you sell your house, you could put maybe 50% down, and it depends on your age, exactly what the requirement is. But you could put, let's say, 50% down and then stop making payments.
Yeah.
Done.
And who cares what the rate is?
Who cares? And FHA, what a lot of people think the reverse mortgage, oh, I'm going to inherit a house that's upside down. FHA caps how much the debt can be versus the value of the home. It's an insurance policy that FHA puts on that home. And they guarantee you're not going to go upside down, and you can't outlive a reverse mortgage, right? So if you get to 100, man, you've been living there maybe 30 years, 35 years. They're not going to kick you out.
Yeah, they're really upset with my mother-in-law. She's 91. She got a reverse mortgage about 25 years ago.
Yeah. Living large, right?
That's right.
She pays what? Taxes and insurance.
Yep.
That's it.
And those are the only things, well, homeowners dues as
It's
well.
HOA if you've got an HOA.
So that is an opportunity. I mean, for the baby boomers that are moving into that, and that is the
And
largest.
what else does that do now? It helps with more inventory.
More inventory.
Now, they're going to be bigger homes, and that may, at some point,
That has prices have to come down.
flatten
Yeah.
the prices on,
hmm
I don't want to say luxury homes, but probably figure on the mid.
And also,
and
when I
upper
say prices
price
come
homes.
down, I mean not appreciated 19%. Like
Right.
like
More of a
two-
flat.
more like like
appreciation.
2%.
Well,
Right.
I did see some stats where the median home price now is like 412,
428.
428, where it was 450 something earlier
Yeah.
this year. That doesn't mean the prices on these, it doesn't mean the values have gone down. It just means people aren't paying more than the asking price anymore.
Right. Yeah, I think in May, the average home sold for 102% of the list price,
It doesn't surprise me.
which is insane, right?
I bought a lot in Inglewood, Florida, and the house next to me was pending when I bought the lot, and it was listed for $699, and it finally went through, and I was checking to see what the sales price, and it was sold for $725. So the asking price was $699. It sold for $725.
I mean, for example, I've listed a house in Concord in May, and it sold for 102% of list price. I listed a house in Charlotte in the end of June, and it's probably going to sell for 98.5% of the list price.
Yeah, the pricing of the homes, and I talked to a lot of my agents that I work with about pricing it right. 3 months ago, you couldn't price it wrong. You were going to get an offer, right? You were going to sell that house no matter how you priced it. Right now, if you price it way too high, it may sit for 2 or 3 or 4 weeks. Oh, God forbid.
Right.
And that's going to spook the market. Like, what's wrong with that house? So I've got an agent that I've known for a very long time, and he would rather price it a little bit under and get a couple people bidding on that house. He
Sure.
thinks it's going to do much better if he prices it a little smarter and more conservative. You're not driving away some of the traffic from the get-go.
Yeah, I mean, Don Harris, he's a friend of ours. He listed my house in Concord, and that was exactly his strategy. Like, hey, let's put it here and, let the market dictate. And that's what happened.
And Don is who I was talking about.
That's
So
exactly- Don Harris, he's
he's
great.
sold a lot of homes, but
Yeah.
he saw quickly that the market is shifting.
Sure.
Yeah.
Now, market shifting, the media is going to say it's crashing.
Don is not one of the Redfin model.
No, he is not.
He's an actual professional real estate person.
He's probably the best.
But in 2019, 2018, when you listed your house, how long did it take to sell?
1819?
Yeah.
I mean, what it would take, 30 days.
Yeah, 4,
40.
6, 8 weeks.
Yeah.
That's a normal market.
Yeah.
Right. And so right now people are, oh my gosh, I listed my house 2 weeks ago and it's not sold.
Yeah.
And they think the market's crashing. No,
But the
we're
average-
normalizing.
Yeah, the average day is still 19 days on market. Like we're still
That's insanely fast.
That's people have been used to you listed on a Friday and you have multiple offers before Sunday evening.
Right. They were hoping for 19 hours to get that offer, not 19 days.
Yeah.
So if you're in the mortgage business and you have unfortunately been dedicated to refinancing, cash out, that kind of stuff, you're going to be hurting.
Not the best time to be in the business if that's what you do.
If that is your business model, you know it's going to have to change for you if you're going to stay in that business. What are your recommendations to folks that are doing that?
So a lot of people, I've got a guy on my team who was in a refinance house and he saw the writing on the wall that rates are starting to go up and he knew I need to get out of this industry, of the refi industry, because it's so dependent on the market and rates. And you've seen a lot of people that are used to doing lots of refinances trying to get into the purchase business. And so you've got a lot of companies, the better.coms and the ones that are doing the layoffs now, they tried to keep their staff as long as possible. It's hard to restaff,
Sure.
Right? So they hang on, and the way they hang on is they try to go very bottom of the profitability of a loan and maybe even take some losses on the loan to try to keep volume up, right? We're making it up in volume.
Yeah.
They're trying to protect the jobs. And at some point they just got to let go and say, we can't manage this anymore.
Sure.
And we're going to the end of our reserves. So now we need to make profit on loans. We've got to raise our rates back up.
Sure.
That's going to slow them down a little more. And they just have to let staff go. So we had to staff up, and all mortgage companies were insanely short in 2020 and 21
Sure.
and trying to hire anybody they could. Well, now it's the opposite problem. We have capacity for $4 trillion in production, but we're doing $2 trillion in production. There's a lot of people you don't need. So if you didn't get out already, look, but it's hard. If you're a refi guy, it's going to be hard to get into another mortgage place. And a lot of the people that got in on the refi boom, we're doing something else before.
Right.
And we need a healthy pruning of the marketplace.
We do.
We
A
do.
reallocation of workforce.
That's
for
it.
Sure.
I was
Yeah.
going to say the same thing with the realtors.
Yeah.
As well. There's a lot of people that are doing it part-time.
I feel like everyone's a realtor these days.
Yeah,
It has been for the last 2 years. Yeah.
Right.
And really, if you're only doing a few transactions a year, you're really, unless you have been in the business for 30 years and now you're cutting back, you're really doing a disservice to the public out there. Because if you're somewhat new to the industry and you're still only doing a few transactions a year, you don't really have the experience that you're going to be able to help these customers out the best, because things evolve, things change. You see all kind of stuff out there, and you really need experienced people out there helping you if you're looking for a home.
Yeah.
What do you, where do you think the opportunities are going to be for the next year?
Man, I've got some people who think the mortgage, the real estate market is going to crash, right? And they're holding their cash. And I think that they're missing the boat. I feel like nationwide, we're about 3.5 to 4 million homes short. New construction, you've got about a third of new homes that are built directly for rentals.
Right.
So new construction's not going to save the day. It's not a quick fix. The marketplace can absorb some foreclosures, which we're seeing more foreclosures, but that's not crushing our real estate values. As of May, we're still increasing crazy speeds, right?
Sure.
Mm-hmm.
So I think the opportunity is not sticking your head in the mud and waiting for a year. I think that's, you've missed the opportunity. I do think we'll see the market open up and get a little bit more normal. Rates probably will top out in September, hopefully. The way that inflation data, it's a rolling average. They always replace last year's number. And last summer, we had inflation numbers that were in the zeros, 0.1, 0.4. This year, they're being replaced by 2% inflation. So it makes it look like it's much worse than it actually is. September was the last really low number. Come October, we're going to start replacing higher numbers on that rolling average. So inflation should appear to start coming down. That should open up some more opportunity for rates.
Mm-hmm.
First-time home buyers might be able to come back into the marketplace a little bit. But if you're an investor, you just got to run the numbers. And if the numbers work, I'm not sitting on the sideline right now.
Right.
I think that the boat you're going to miss is by saying I'm going to wait 6 to 10 months.
Yeah, your rents are going to continue to increase over time, even if your interest rates are a little bit higher than they have been. The issue is you've been typically overpaying for these homes because the values continue to go up.
Right.
And the way to get around that obviously is to put more money down,
Right.
so you still keep up with your cash flow. Because for the most part, we don't see values dropping. We just see the rate of appreciation slowing.
Yeah.
So those properties are still going to go up in value. You're still paying a payment based on the same dollar figure for 20 years.
Right.
And inflation is going to make that dollar worth less and less and less.
Right.
And while your values and your cash flow continue to go up.
And people miss that part of your payment is a forced savings account, right? Part of your payment's going towards principal.
Right.
Yeah.
So once you calculate in your amortization growth of the value of your home, right? That's putting extra equity into your home every month, every payment. It's still a good opportunity for most people. Now the numbers might be tighter.
Yeah.
Right.
But it's the whole thing. Like what we tell the staff here when we talk about it, like if we don't make loans, we don't make money. Now the market tells us a lot of times not to stop making loans, but how do we change and like alter what we do in making those loans? We still have to make them. Same thing in real estate. If you're a real estate investor, you don't stop buying real estate.
Mhm.
Maybe you change how you buy it, change a little bit of what you're doing because of certain market conditions. But you don't stop buying, because then how do you make money? If you just hold your cash and you do nothing, you're in a 9% inflation period, you're losing a lot of money.
You're safely losing money.
You're safely losing money.
Right.
It becomes a contest on how, if I lose less than you do, then I'm winning.
And I was the smart one. Yeah.
So bottom line is, as an investor, you make your money on the buy.
On the purchase. Yep.
And unfortunately for real estate agents, it's going to be very difficult to work with investors because you're dealing with houses that are on the market unless you have a line of off-market properties. So they're going to have to buy below market, and they're going to have to put more money down in order to make the numbers work.
Or look at doing an alternate type of rent, right? Maybe it's not a long-term purchase season. Maybe it's a short-term rental purchase season.
Yeah, could be.
Right? Your margins could be higher. You got to run the numbers, and you have to have a backup plan. What if that short-term, right? What if the county puts an ordinance in place and stops short-term rentals?
Yeah.
North Carolina should be pretty protected from that happening because of the Wilmington case that we saw. Charlotte, I heard, had plans to tamp down on short-term rentals, and as soon as that Wilmington case was settled, they stopped that change. But other states, you just got to watch out what could happen to this short-term rental.
Right.
But you just got to run numbers, and it's a business decision, not an emotional decision.
That's a very important point. If you buy for a short-term rental, make sure it works for long-term, because you always have to have an exit
There's a backup
or a backup.
Yep.
Bryan, thanks so much for joining us in person for a
Yeah.
change. That's been
I
awesome.
like it. Yeah.
Great to be here.
Now you get to look at my face. Thank you so much for joining us on the Real Estate Investors Show. Hard money for who? Real estate investors. We are Carolina Capital Management, private lenders for real estate professionals in the Southeast. If you would like for us to take a look at one of your projects, just go to carolinahardmoney.com and click on the Apply Now tab. If you are an accredited investor looking for passive returns, click on the investor tab.
Yeah. Same website.
Don't forget to like, share, subscribe, hit the bell, and sign up for Wednesdays with Wendy. It's been a pleasure. Oops, can't see that one. See you next week.